Hello, everyone, and welcome to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and I'm really glad you've joined me today. Today's episode focuses on one of the most important, yet often overlooked, skills in investing and trading. We're going to explore how to size positions using macro risk, why professional investors always think about risk before reward, and how adopting a risk first mindset can help you become a more disciplined and successful investor over the long term. When people first enter the financial markets, they're usually focused on finding the next winning opportunity. They're searching for the stock that's about to double, the currency pair that's about to break out, or the commodity that's about to rally. It's completely understandable because that's what most headlines, social media posts, and trading videos tend to emphasize. But here's something many experienced traders eventually learn. Finding a good investment idea is only one part of the equation. Knowing how much money to commit to that idea is often even more important. In fact, many professional investors would argue that position sizing is one of the biggest differences between consistent long-term success and repeated disappointment. Today's episode is all about understanding position sizing through the lens of macroeconomic risk and why what is often called risk-first investing can transform the way you approach financial markets. Let's begin by discussing what macro risk actually means. Macro risk refers to broad economic, financial, political, and geopolitical developments that affect entire markets rather than individual companies. Instead of focusing on one business or one earnings report, macro investors pay attention to the larger forces shaping economies across the world. These forces include central bank interest rate decisions, inflation trends, economic growth, recession risks, labor market data, banking sector stability, government fiscal policies, trade disputes, geopolitical tensions, commodity supply disruptions, and movements in major currencies. Each of these factors has the ability to influence not just one company, but entire sectors, regions, and global markets. For example, when inflation rises faster than expected, central banks often respond by increasing interest rates. Higher interest rates can reduce consumer spending, increase borrowing costs for businesses, and place pressure on equity valuations. At the same time, currencies, bonds, commodities, and even property markets may all respond differently to the changing economic outlook. This is why macroeconomic developments deserve the attention of every investor, regardless of whether you're trading stocks, exchange traded funds, commodities, foreign exchange, or indices. Understanding the bigger picture helps you appreciate when market risk is increasing and when it may be appropriate to become more defensive. Now, let's move on to position sizing. Many investors spend countless hours trying to perfect their market analysis. They study charts, technical indicators, company financial statements, economic reports, and news headlines. While research certainly matters, surprisingly little time is often spent deciding how large a position should actually be. Imagine correctly predicting that gold prices are going to rise over the next several months. If you invest far too much of your portfolio into that single position, normal market volatility could trigger emotional decisions long before your original investment thesis has the chance to play out. On the other hand, if you've carefully calculated an appropriate position size, temporary market fluctuations become much easier to tolerate because your overall portfolio remains protected. That's why professional investors place such a strong emphasis on position sizing. Proper position sizing helps limit downside risk, protect trading capital, reduce emotional decision making, improve portfolio consistency, maintain confidence during volatile periods, and avoid catastrophic losses that can take years to recover from. One of the most valuable concepts every investor should understand is what's often referred to as risk first investing. Rather than beginning with the question, how much money can I make? Successful investors begin by asking a completely different question. They ask, how much am I willing to lose if I'm wrong? That single change in mindset completely alters the investment process. Instead of becoming emotionally attached to the potential reward, investors first define acceptable risk. A risk first approach typically includes establishing maximum portfolio risk, determining acceptable risk per trade, assessing current market volatility, evaluating macroeconomic uncertainty, considering correlations between different positions, and calculating the appropriate position size before entering the market. Notice something important here. The goal isn't to eliminate risk. Risk can never be eliminated because uncertainty is part of every financial market. The objective is simply to ensure that no individual investment has the potential to cause serious damage to your overall portfolio. So let's discuss exactly how to size positions using macro risk. The first step is analyzing the current macroeconomic environment. Before opening any position, it's worth asking yourself several important questions. Are interest rates rising or falling? Is inflation accelerating or slowing? Are central banks tightening monetary policy or beginning to stimulate economic growth? Is recession risk increasing? Are financial markets experiencing elevated volatility? Are geopolitical tensions creating additional uncertainty? The answers to these questions help determine whether market conditions are relatively stable or unusually risky. When macroeconomic uncertainty increases, many experienced investors naturally reduce their position sizes. They don't necessarily stop investing altogether. Instead, they simply recognize that uncertain environments require greater caution. The second step is evaluating market volatility. Not every asset carries the same level of price risk. Technology shares often react sharply to changing interest rate expectations. Gold frequently experiences significant price swings during geopolitical uncertainty. Oil markets can become extremely volatile following disruptions to global supply. Currency markets may react within seconds to central bank announcements or unexpected economic data. The greater the expected volatility, the smaller the position size generally becomes. This helps maintain a relatively consistent level of overall portfolio risk, regardless of which market you're trading. The third step involves determining acceptable portfolio risk. Professional investors rarely expose large portions of their capital to a single investment idea. Many adopt straightforward rules such as risking no more than 1% of their total portfolio on any individual trade, while limiting overall portfolio exposure to around 5% across all open positions. Some investors become even more conservative before major economic announcements or important central bank meetings by temporarily reducing exposure until uncertainty subsides. These rules create consistency. Rather than making emotional decisions based on excitement or fear, investors rely upon predetermined guidelines. The fourth step is defining your stop loss before entering any position. This is absolutely essential. Without knowing where you'll exit if the market moves against you, it's impossible to calculate an appropriate position size. Suppose you've decided your maximum acceptable loss is £500. If your stop loss sits 5% below your entry price, your position size should be calculated so that a 5% decline results in no more than that predetermined loss. This disciplined approach allows investors to survive losing trades while remaining financially prepared for future opportunities. The fifth step is reviewing correlations between investments. Many investors mistakenly believe they're well diversified simply because they own several different assets. However, during periods of macroeconomic stress, many markets begin moving together. Global equity indices often decline simultaneously. Banking shares frequently respond as a group to changing interest rate expectations. Commodity-linked currencies may move in very similar directions. Owning several highly correlated investments can unintentionally increase portfolio risk well beyond what an investor originally intended. Understanding these relationships is another important aspect of managing macro risk effectively. Another characteristic shared by experienced macro traders is flexibility. Markets are constantly changing. Economic data surprises, elections, geopolitical developments, central bank speeches, inflation reports, and employment figures can all alter market conditions very quickly. Professional investors understand that position sizing isn't something calculated once and then forgotten. Instead, exposure is continually reassessed. During periods of heightened uncertainty, investors may reduce leverage, increase cash holdings, diversify across additional asset classes, scale gradually into positions instead of investing all at once, or simply wait for volatility to settle before increasing exposure. Flexibility is often one of the greatest strengths in long-term investing. Let's also discuss some of the most common position sizing mistakes. Many investors unintentionally increase their risk by investing based purely on confidence rather than objective calculations. Others ignore changing macroeconomic conditions and continue using the same position sizes regardless of whether markets are calm or highly volatile. Some increase their position sizes after several winning trades because confidence grows, while others hold oversized positions immediately before important economic announcements. Additional mistakes include failing to diversify effectively, moving stop losses further away simply to avoid taking losses, and risking inconsistent amounts across different trades. Most of these mistakes have one thing in common: they're driven by emotion rather than disciplined planning. Developing consistent investment rules helps remove much of that emotional decision making. Professional macro traders also recognize a very important reality: no economic forecast is perfect. Even the world's most respected economists and fund managers regularly experience losing trades. Markets are influenced by countless variables, many of which cannot be predicted with complete accuracy. The difference is that professionals rarely allow any single mistake to threaten the long term survival of their portfolios. Instead, they rely upon disciplined position sizing, consistent risk management, and careful macroeconomic analysis. Over time, this consistency often matters far more than achieving a high percentage of winning trades. Another valuable habit is building a repeatable risk management framework. A structured investment process helps remove uncertainty from decision making. That framework should include clearly defined investment objectives, maximum portfolio risk limits, position sizing rules, stop loss strategies, diversification guidelines, ongoing macroeconomic analysis, regular performance reviews, and a commitment to continuous learning. Investors who consistently follow a structured process often make calmer decisions during periods of market volatility because they've already established their rules before emotions begin influencing judgment. Technology has also made professional risk management much more accessible than ever before. Modern trading platforms provide real time market prices, sophisticated charting tools, integrated risk management features, economic calendars, market news, and fast trade execution. These resources help investors monitor markets more effectively and make better informed decisions as conditions evolve. If you're looking for a world class, cutting edge, user friendly trading platform app to support your investing journey, I encourage you to visit crystalbellmarkets.com/platform. It's designed to give both newer and experienced traders access to powerful tools that can help improve market analysis, trade execution, and overall risk management. It's well worth exploring if you're serious about becoming a more disciplined investor. Education, of course, remains one of the strongest forms of risk management. Markets never stop evolving. Central banks change policy, inflation rises and falls, economies expand and contract, and geopolitical developments continually reshape the global investment landscape. The more you understand these forces, the better equipped you'll be to manage uncertainty with confidence. If you'd like to continue building your knowledge, I'd also recommend listening to the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. It's packed with beginner-friendly discussions covering trading, investing, macroeconomics, and financial markets, making complex subjects easier to understand whether you're just starting your investing journey or looking to deepen your market knowledge. Before we wrap up today's episode, I'd like to leave you with one final thought. Learning how to size positions using macro risk is one of the most valuable skills you'll ever develop as an investor. You cannot control inflation. You cannot control interest rates. You cannot control geopolitical events or unexpected market shocks. But you can control how much capital you choose to place at risk. That's where long-term success begins. Risk-first investing isn't about avoiding opportunity. It's about making sure you're still in the game tomorrow, next month, and many years from now. By understanding macroeconomic conditions, respecting market volatility, calculating sensible position sizes, and maintaining disciplined risk management, you'll place yourself in a much stronger position to navigate both bull markets and bear markets with confidence. Thank you so much for joining me for today's episode of Financial Market Insights for Traders. I'm Sophia, and I truly appreciate you spending part of your day with me. Until next time, keep learning, stay disciplined, always respect risk, and remember that protecting your capital is one of the smartest investments you'll ever make.